Hello and welcome to this week's episode of Nucleus Investment Insights. Today we ask the question, will US commercial property be the epicenter of the next property crash? As many of our listeners are aware, the work from home dynamic has drastically changed commercial office property fundamentals, particularly in the US and also here in Australia. There have been some spectacular falls in value in many US office markets that we delved into last week. In this episode, we're going to explore this and many of the other subsectors of the commercial property market here and around the world. Just a quick reminder, this podcast is general advice only and is not intended to be specific to your personal situation. If you do want to discuss your personal financial situation and how to improve that, you can book a call with me or one of the advice team at nucleuswealth.com/contact. Today, as always, we have Nucleus Wealth's co-founder and chief investment officer, Damien Klassen. Damo, welcome.
Hi, Sam.
Hi, Damo. Today, we also have Julian Campbell-Wood from Resolution Capital. Julian is a portfolio manager at, like I mentioned, Resolution Capital, which is a global property securities fund listed on the ASX. Julian, welcome.
Sam, Damo, good to be here.
Excellent to have you. And Julian, you're probably the best person to give us a bit of an intro just about who you are and your experience. So, the floor is yours.
Yeah, thanks, Sam. Background for me, been at Resolution Capital a little over 10 years now. So joined the business in 2013. Before that, I spent time in London, also on the real estate side for 8 years prior, direct real estate funds management and also European real estate on the sell side. So since joining ResCap, been working as an analyst, then co-managed the REIT portfolios along with our CIO, Andrew Parsons, and in the last 5 years been one of the portfolio managers on the global strategy.
Fantastic. Thanks for that. My name's Sam Kerr. I'm the Senior Financial Advisor at Nucleus Wealth. Today is a pre-record, but we are usually live every Thursday at 12:30 Australian Eastern Time. So normally you can jump onto the Nucleus Wealth YouTube channel and ask any questions that come to mind. But today you can always have a bit of chat in the comments section with the other viewers after the show is done. You can follow us on your preferred podcast platform as our show is available on all the majors. So that's pretty much the housekeeping out of the way. So Damo, over to you to get the ball rolling.
Yeah, thanks. So look, we're obviously run a few different things on property and there's a bunch of different flavors of it. And what we really wanted to do was, we've spoken a few times about the US office property market. And so we wanted to get a bit of a look at that. Mm-hmm. But also Resolution Capital covers stuff right around the world. So we want to sort of dig into some of the more, some of the different property sectors as well and just sort of touch base on what we're seeing within that. There's obviously been a rapid rise in interest rates and the effects of that on property prices is, and you know, especially in terms of leverage properties, there's potential for things to go wrong. And so just wanted to sort of touch base with somebody who's dealing with this on a day-to-day basis. So with that sort of behind us, Julian, let's start with the big one, the US office sector. So there's a lot of talk and suggestions that, that we've seen some big falls in prices in the office sector in particular, and whether that leads to problems that are sort of coming down the road as the debt starts to roll off in that sector and needs to be refinanced, and whether we've seen some valuation changes just because of the rising interest rates. So I guess what are you seeing in the US commercial property market? Are you invested there at all, and what's the big picture view?
Yeah, okay. Yeah, there's a few things just to frame the discussion, I think. And firstly, to be what are the trends that are driving up office markets around the world, and then why are they particularly challenging in certain parts of the US? And also, what's the relevance of that for the listed property market versus the direct? So in the last 3 years, the COVID experience has changed a couple of things in terms of office property, and utilisation has been the key one. So how much are we all actually in the office? And that's been different in different markets around the world. So in Asia, for example, utilisation is pretty much back to pre-COVID levels, so normalised completely. Hong Kong, Japan, a little bit less than China. And then when you look at the European markets, Europe, such as Paris, etc., Utilisation, again, is much higher. You move to the UK, a little bit lower. The US and Australia is actually toward the lower end. So utilisation is lagging in Australia and the US. And what that's...
And actually, sorry, before we jump onto that, what are you putting that down to? What are your thoughts on the difference?
Some of it's tenant mix, some of it's the commute, and some of it's the experience actually of the cities in which these buildings are in. So in London, for example, typically a lot of people commute in from the commuter belts, and that's meant that people really want to work from home because it's saving them time. In certain markets in the US, it's the commute, but it's also the social challenges that certain cities have faced. Seattle, San Francisco, there's some real social challenges there. And in Europe, for example, Paris, downtown Paris, it's 3 to 4% vacancy because the experience of people going back into the office is a lot more positive. There tends to be shorter commutes, and the experience of being in those cities is much better. In other markets, it's also the tenant composition. So governments and tech workers have been particularly slow to get back to the office. So those markets where you have a lot of tech, like San Francisco, that's been sort of ground zero for some of these dynamics in office markets, and it's now 30% vacant.
Yeah, right. And so, and is there, I guess, are you seeing, is this data changing? I'm assuming it's changing a bit over time, but is there any sort of trends where it's like, look, it's gradually building its way back, or it actually looks like it's flatlined in some of these kind of cities? They're the ones with, I guess, where the vacancy rates are high.
Yeah, it's definitely improving, and that's due to some of the work from home policies shifting. Using the Australian example, the banks here were quite open to having people work from home with no requirements to be in the office at all. That's changing a lot, as you've seen in the press, and that will improve the utilisation for those businesses. Government as well. There's a push in the US, for example, to get government employees back because they're really not in the office at all, and that's an issue in Australia as well. So some of those work from home policies are shifting, and that's improving utilisation. And the important thing about utilisation is when businesses have a view or an understanding of how they're actually going to function in terms of the number of people are in, the number of days, how much space they actually need, then they can be clearer on long-term decisions and lease the amount of space they need. Because this changing way that everyone's working with work from home, ultimately it's mean that tenants aren't signing longer-term deals to the same amount of space. And you've seen vacancy spike up in certain markets, particularly Australia, and also the US. You look pre-COVID, Sydney vacancy was sort of mid-single digits. Now you're up in the teens. And that has an impact on office fundamentals, and the US is much worse than that.
Yep. And I'm assuming that it's still the case that the A grade is a lot more occupied than say the B or C grade.
Yeah. Yeah, and that bifurcation is actually being magnified by a couple of things. One, businesses are using the best space to attract their tenants or draw their tenants, not their tenants, their staff back into the buildings. So the demand for that high quality space is there. People want the amenity, they want better quality fit outs, better quality air quality, etc. So the demand is clearly stronger for those high quality premium buildings, and that you can see that in the vacancy stats as well.
Yes. So if we're going to pick, say, Sydney as an example, something close to home, obviously. That So what are we talking about? An A grade versus a B grade building in terms of vacancy rates? If you're talking, was it 15%? You're saying the overall vacancy rate is?
Yeah, it depends on how you draw the lines around the city, but yeah, you're looking at sort of low to mid-teens in terms of vacancy, and the A grades, I think the premium grade you'd be in the single digits, and the B grades you'd be well above that, and that's true of most markets, and that's actually in our mind going to continue because not only have you got the tenant demand being tilted towards those A grade premium buildings, but also the sustainability and energy requirements, meaning more and more capital is required to get your building to be energy efficient, and that's where the tenant demand's going. So this B and C grade stuff that doesn't have the energy efficiency is also losing tenant demand from that perspective. So you're just going to see this widening gap of the quality spectrum of office.
Yeah. And we spoke a little bit last week with some distressed debt on this, and we just talked about the difficulties in terms of converting that office into residential, and just the floor plates are generally not suitable. I'd guess so that the C grade stuff is probably easier though to convert to residential, because it's probably going to have smaller floor plates or be a bit older. Is that right or not?
Yeah, I think the grade doesn't necessarily speak to the convertibility of the building. It's more just the quality of whether it's the fittings, the mechanical of the building, etc. But it's really, you're right, what are the floor plates? Are they too large? Can you not get natural light? What are the ceiling heights, etc.? And that will define whether it can be physically converted. But it's really the economics. Like, are these buildings at a value where you can actually spend the amount of capital to convert them and then actually sell them at appropriate residential prices, even if they can be converted? So I think your point around C grade, you're right, those values are probably lower, and you may get to a point where the buildings actually get scraped and then you can look for an alternate use. But the convertibility, it's really around the physical structure, but also it's the value basis. So you look at a value per square metre, are these low enough to spend the conversion costs and then deliver product at the right price point?
So in your portfolio, I did note you've got a reasonable amount of residential, or certainly some of the bigger names you had, and there were sort of residential names. So, and I guess we've seen some pretty rapid growth of rents in the US, but that looks like it's sort of tailed off and potentially going the other way. I'd be interested in sort of your thoughts on I guess why you're invested more in the residential side and where rents are headed, and in the US, let's start with first, and then maybe we can talk about it elsewhere.
Yeah, sure. So in the US, just to give some context, this is all rental residential, so not in condo development, etc. And unlike in Australia, where you might get yourself a nice healthy 3% cash yield, we're investing single family homes where you're getting a 5.5% to 6% initial cash yield, and also the multifamily, so the rental apartments. So pretty healthy initial starting cash yields from these portfolios. And you're right, rent growth is moderating from unusual COVID levels through 2021, but it's still at pretty reasonable levels when we look at the coastal multifamily markets and, importantly, the single family residential market. And I'll split those two because the fundamentals are slightly different. But in the single family market, in a lot of the Sunbelt markets where these homes are located in the portfolios we invest in, you're still seeing rent growth of 5 to 8%, which is pretty healthy. And that reflects the supply and demand fundamentals. They just haven't built enough single family homes. Occupancies are high, 97, 98%, and incomes have been growing. So when you look at the rent to income levels for an Invitation Homes, which is our largest position, it's barely changed. So it's still 5 times income to rent. So it's still a pretty healthy demand picture. The supply has been constrained, and that's why you're seeing that healthy rent growth, but it is moderating. Where you're seeing more rent moderation is in the Sunbelt apartments, because you've just seen an explosion of supply. The natural response when you see strong population growth, strong rent growth, developers are coming into these Sunbelt markets because you've got land available, and the volume of supply in those markets is significant, and that's why you're going to see the rent tail off. So we moved out of those Sunbelt apartments 12 to 18 months ago, and we've concentrated on the coasts where you've got more supply constraints. And rent growth on the coasts in California, Seattle type markets, Boston, New York, DC, you're in the low single digit range. So yes, it's moderated meaningfully, but it's still reasonable and a reasonable supply demand outlook.
Right. Okay. And then elsewhere in terms of rents, so are you involved in any residential stuff in Europe or Australia, or is it?
So we are also in Canada, so slightly different dynamics because it is regulated. So you can only increase rents on sitting tenants by inflation or the amount dictated by the local municipality. So it's a slightly different dynamic, and it's more of an affordable exposure there. But in Canada, similar to Australia, you've got extraordinarily strong population growth and limited supply. So rents for new tenants are increasing 25% plus. So right. Very, very strong dynamics in that Canadian affordable rental market. We've got a small position in Germany, sub 1% in German residential. And the issue there is capital structure. It's not the fundamentals. The fundamentals are actually very strong. Rents are growing 3 to 4%. It's a regulated market. You've got very strong demand because of the influx of population into Germany, and completely constrained supply because the portfolios are trading below replacement cost. It's uneconomic to deliver new supply. You actually can't deliver supply at the rents these portfolios are at. So the real estate fundamentals are good, but one of the issues that you can have in real estate is too much debt at the wrong point in the cycle, and that's an issue that you do have in some of these select European markets. That's probably a point we'll come back to because the vast majority of the REIT sector is in significantly better position. But in Europe, there's a couple of vehicles there that have too much leverage, and that's what's more recently kept us out of that German residential segment.
Yeah, well, actually, so I mean, it'd be good to run through some of those other sectors, but I guess given that the large, given that issue, so in 1991, I guess in Australia, we went through this whole process, and we were like, and then again in the financial crisis, where a lot of it was about too much leverage sitting in property, and then when the property prices fell and the whole thing tipped over. I guess which are the markets where you're most concerned? And I guess as a broad picture sense, I think people are saying generally that the leverage is not as bad as it was in a lot of those times.
Yep.
But so have you got any thoughts on where are the most dangerous ones? So you spoke about German residential as one. There are other pockets, I suppose.
Yeah, Europe, I'd say, is the worst region, but it's most specifically Germany and Sweden. Sweden probably even more so than Germany, because at least with the German residential, the real estate fundamentals are very strong. But in Sweden, you've got a lot of highly levered vehicles with short-term and floating rate debt. So in Sweden, you're also seeing rights issues, and there's probably more to come, to be frank. So that is, the REITs of old. You're seeing that play out in Europe. Other markets where we've got some concern, but the fundamentals have held up, has been markets like Singapore, where you've got LTVs up in the 40+ range, and portfolios valued off very low cap rates.
Sorry, just to define, that's loan to value ratios. So
yeah, sorry, loan to value ratios up 40-45%. So they're hitting some of the covenants they've got in terms of being able to distribute. But cap rates in the office market there are still in the 3s. So Singapore is a market we've got some concerns about, but fundamentally is doing quite well from an economic standpoint. But we're not investing in that region. Elsewhere, US office REITs would be one I'd put in the bucket, which probably have too much leverage given the fundamentals. And you are seeing some dividend cuts there. Not yet seeing rights issues to that degree, but you are seeing dividend cuts as well.
Yeah, and so broadly speaking, so we've seen sort of 15-20% falls in prices there. Is that right?
In which sort of price? You mean listed
in
rates?
In the US commercial.
In terms of the underlying values, yeah, that's about right.
Yeah, and so and then the loan to value ratios there started a little bit higher. Am I right or not?
So yeah, in the US, the loan to value, and these are our values because the companies there don't actually value their portfolios as you do in Australia or Canada. So when we look at our portfolio, it's about 27%. So 26-27%. So the US is actually in very good shape from a capital structure perspective, with the exception of the US office REITs most particularly. But the US is in good shape. Australia as well.
Sorry, I'm just trying to get a feel for how much leverage you think was in the US office REITs.
So US office REITs, some of them be pushing up towards the 35-40% plus. Yeah.
Okay. And then and that's including the fall though. So it started at 25, and then you've had a 20% fall, and so now you're at 35. Is that
No, so the 25 I gave you was our portfolio.
Yep.
But that's not US office. That's obviously a mix of different properties.
Across the mix. Yep.
But the US office REITs, some of them have much more leverage than that. Like if you looked at debt to EVs, be north of 60. But in terms of loan to values, again, this is debt to GAV, you'd be in the 40s and 50s. Right. But because you don't value the portfolios in the US, don't necessarily have those same LTV type covenants.
Okay. So, and let me just get this right. So for people who I think I've got the terminology right, but so basically, if you look at what they started as a value it was 40%, say, a loan to the actual value they had in the books might have been 40, 50%. The values have come down by 20%, and so now your loan to value is more like 50 to 60%.
Yeah,
Loan to the actual underlying value that you could sell it at.
Yeah, and some values in the US office markets have come down well in excess of that.
Yeah. And Julian, just if you don't mind clarifying, just for the viewers as well, GAV and EV.
So GAV is just gross asset value. So the reason we just use different terminology in the US, because the companies don't value their portfolios. They're all at historic depreciated costs. So we value them. So we look at the NOI streams, we apply a cap rate, and just as the valuers do here. But when you look at the accounts of a US REIT, there's no value per se as you would if you looked at Center Group or Dexus or any of the A REITs.
Yeah. And good point for anyone who's investing. If you're ever looking price to books, is that it's obviously not comparable when you get big price movements in these. It's between the two.
Okay, and we're just going to go to a quick sales message. We'll be back in a moment. We'll be back with the investment insights very shortly. Nucleus Wealth is an active and passive investment manager. If you like what you're hearing and want some help with your investing, we can do it for you via our active portfolios. Our tactical and core portfolios use the insights shared in this podcast to construct and manage your investment. We blend tactical portfolios to offer our combinations of international shares, Australian shares, government bonds, and cash. We vary the asset allocation with the goal of protecting your capital in times of market uncertainty. We also have active international and Australian share portfolios. These are chosen using our quality and value investment philosophy. You can find out more at nucleuswealth.com. Now back to the show.
Let's change tack to some of the more niche sectors. Ones that sort of, in recent years, the self-storage market has had a decent run as everyone buys a lot of stuff, and then during pandemics, and then they need somewhere to stick it once they no longer want it. And data centers. So, but let's start with the self-storage. So, there's this real push for products over services for a number of years there, and now we've sort of flipped around back to more to services. Had a bit of a rough month last month in self-storage. I think you still have some self-storage in your portfolio. Is that right?
We do, yes.
Yep. See what your thoughts are around that market and whether.
Yeah, you hit on one of the big question marks, but the other is also is work from home. So that was a big driver of storage demand as well at the outset. And then also in the US.
Sorry, is that just people moving the stuff out? I need to put an office.
You need your second bedroom. So
right.
you put the jet ski and whatever you've got in that second room into storage. So that was a driver of demand. Ultimately, storage feeds on societal change. So you just need that sort of, whether it's businesses opening, closing, housing transactions, students, etc. So anything that disrupts that is what disrupts storage demand. So the work from home dynamic was a positive at the outset of COVID. You also had a lot of changes in terms of businesses, inventory. So a lot of things were moving around, and that was a boost to storage demand. When we look at what's happened to storage, you alluded to a rough month. It's because the US housing market, the transactions have slowed materially because 30-year mortgages are 7.5%. So people just aren't moving homes. So just for context for your viewers, the US benefits from long-term fixed rate mortgages. So if you've got a fixed rate mortgage at 3 to 4%, you don't want to sell your house and move and then take the current fixed rate at 7.5. So what that means is the transaction volumes are down a lot. So there's not a lot of people moving. And the US is a market where you've got a lot of interstate migration as well. So that demand has really come out of the self-storage names at this point in time, and that's what's impacted them. And also I'd say it's a moderation from COVID periods. Like they had rents up 20, 30+%. So you're also on the backside of that demand. So it's a combination of rates normalizing from abnormal COVID pricing and to some of the demand, given the housing velocity is slowed, is not there at the moment.
Yeah. And would you, in terms of economic sensitivity, I guess I feel like self-storage is an area that's grown fast enough over the last sort of 15, 20 years, is that I'm not quite sure whether, so if you hit it feels like if we hit a downturn and people are worried about their jobs and all that sort of stuff, and where can I save some money? getting rid of my self-storage sounds like a reasonable place, but I'm just not quite sure whether we've got sort of enough history on that to sort of say whether that's the case, or whether it's going to be more, I guess, stickier than other sort of discretionary spend.
Yeah, in the US, you've got the history because the sector's been around for a lot longer, and it is typically relatively resilient. So people tend not to want to deal with what they've got in storage, and it is often less discretionary than what people think. You might find people will cut back on that, the more expensive holiday or the eating out more, that sort of discretionary spend before dealing with your storage need, because it is a typical needs-based product. Like, you're not putting stuff in storage because you feel like it, it's because you need it for a period of time. And yes, if you really got to cut back, yes, there is an element of your ability to either downsize your unit or cut it all together. So you will see some pressure on NOI, so net rents in a recession, but not to the same magnitude of some of the more economically sensitive sectors. Historically, things like office markets, historically things like logistics markets or industrial markets. So it does tend to be more resilient than some other asset classes.
Yeah. Okay. Data centers. So, I guess my question here is, there's obviously, we've had an explosion in growth of data centers, and this AI bubble obviously going on, or AI, sorry, certainly rapid growth in terms of AI. But on the flip side, it's actually been quite hard to get some of these chips, and some of the chips are actually quite high end. And whether that means that, you end up with the Googles and Microsofts and Amazon sort of dominating that market, or even just some of the larger data centers sort of managing to getting a lot of the growth, and some of the smaller ones actually just being left with the scraps and not really benefiting. So I guess I wanted to see what, as an outsider looking in, that's sort of my first take on it, but I'd be interested to see whether that's sort of similar to what you're seeing or different.
Yeah, so when we look at the data center market, we've historically split it between the hyperscale data centers, which are owned or leased and owned by your Amazons, Azures, Microsofts, etc., where you've got one facility, large tenant typically controls the space, versus the other part of the data center market, which is your co-location, network dense, more retail oriented. So businesses like yourselves or us may use a data center like that. So in the hyperscale market, less supply constraints, more tenant concentration, the control of those large hyperscalers, and more available supply or ability to put on new supply. That's what's categorized that hyperscale segment.
And I'm assuming that they're also, they're big enough to force some pricing pressures, I guess, in terms of...
Correct.
If you want to try and no charge me for it, that's fine. I'll just build it somewhere else.
So what also changed is that the development returns for those data centers had been phenomenal. So you were getting mid-teens plus development returns, and they've been competed down. But as the cap rates have compressed, the ability to bring on new supply at lower rates has meant that you've had this decline in data center pricing really for a number of years, which has now changed. Because of the supply constraints which have popped up in markets like Northern Virginia, Singapore, Frankfurt, due to power availability. So we have, even in a hyperscale market, which historically has had less supply constraints because they could be in a wider array of locations, that's flipped. And you've now seen market rents increasing quite substantially in these markets, even in the hyperscale segment. And the other side, the retail co-location, network dense, that's your Equinix type facilities. They deal more with the digitization of the economy. So all sorts of businesses that need data center space, need to interconnect, need to have on-ramps to the cloud, etc. And that business continues to be very strong. And that's going to continue. That digitization of the economy is the key driver there. Now, to your question on AI, to us, that is a sort of medium-term demand driver, because the use of AI and the data center needs or AI is still very early in terms of what the physical requirements are. And it's likely that those requirements will be more intensive than what the existing data center footprint is. So
that's what I'd seen, was that, I can't remember what it was. You needed 3 times the air conditioning or whatever it was in terms of the
liquid cooling, and they're going to generate so much heat. That's right. So for us, it's about positioning for that ongoing digitization of the economy. And Equinix is best positioned in that, but also the tightening in the hyperscale pricing market, which is benefiting because landlords just now have more pricing power. So if you looked at the top 10 data center markets in the US, vacancy's gone from 10 to 3%, and that's before any of this AI. So landlords have got pricing power even before we figure out what's going on with AI. But it's likely that the early stage of training these large language models, they don't need low latency. They don't need to be near population centers. So you might see much more data center market in other locations where you've got significant access to power and cheap land. And that's a different sort of market than what we've been trying to position for in the data centers which are in the portfolio.
Yeah. Now, the one of those other sort of esoteric markets is the leasing of the radio towers. So American, we call it
American Tower, cell towers.
Yes. Yeah. Do you look at that at all?
We do. Yes. Yep. We've got a position in AMT at the moment. So there's a couple of things with that business. Very simple business. You basically own telecommunications towers and lease it out to the telcos. It's typically a very predictable revenue stream. So 75% of AMT's revenue is under master lease agreements. So you've got visibility on that over the term. It's also in the US. It's benefited from, there's a fourth carrier who's been building out a national platform, Dish, which is also boosting the growth because as an owner of a tower, you get paid more if there's more equipment being put on your tower. Dish has had some challenges, which has slowed the rollout of that, and that's taking a bit of growth away from the towers. But underlying that is a very predictable revenue stream and a very CapEx efficient revenue stream, which doesn't have a lot of economic sensitivity.
Yeah. So and these guys don't own largely don't own the equipment, do they? It's just they're just in the space. And so, and am I right in saying as well that as your 3G tower, you need a lot fewer towers. The higher you get in terms of 4G and 5G, the more towers, the more densely you need to pack your towers. And so it goes from being I'm Telstra or I'm an AT&T and I've just built my own tower to stick a 3G on it. And now I'm looking at 5G or whatever, and I'm like, actually, I need 10 times as many towers. And so now I'm actually happier to share it. Whereas I'm like, I already built my tower. I'm not going to share it with anyone. Whereas because you got to build so many more now, it's like, yeah, okay, I'll share with the other guys because I've just got to build so many.
Well, in the US, it's quite a mature market, so you don't actually see a lot of new tower development. And the existing telcos have pretty wide coverage given their existing 3G, 4G infrastructure. So yes, it's about upgrading to 5G is the big driver of CapEx, which is important to the telcos. The cell tower REITs, and then it's been the rollout of Dish because again that's a new operator bringing on additional equipment to the towers. That's more what drives the incremental revenue above the in-place contracts. In other markets, yes, new tower development can be a bigger driver of incremental returns and earnings.
Okay, but that's not an area where you're looking at the moment, did you say, or you've got some exposure, but not particularly overweight?
We do have a small position. AMT is actually not in our benchmark, so any position is overweight for us.
Ah, right. Okay. And so I guess where I'm leading that from is that America. I think is it still the largest REIT in the US?
Yes, big company.
Yeah, it's a big market. It's bigger than you think.
That's right.
Okay, so aware of your time. So just quickly, I guess, running through retail sector. So, I think the macro data is certainly showing things are starting to very much weaken in terms of retail. But I think in your latest report, you're saying the micro data is still not that bad.
Yeah, I think that's a fair categorization with different markets and different types of retail. I think also splits. But if you look in the US consumer is in a much better position in a lot of ways than the Australian consumer. Fixed rate mortgages, they deleveraged post the GFC. So they just haven't got the same exposure to rising rates that we do here in Australia. So the sensitivity to the increase in finance costs is lower for the US consumer. So they've been pretty resilient across all forms of retail. It's been such a strong nominal sales environment. Our positioning in the US has been focused in the necessity-oriented segment, so predominantly grocery-anchored, because that's where we saw the better underlying property fundamentals. And by that I mean, in the last 10 years plus since the GFC, very little new retail supply has been put on the ground. And that means that vacancy in that open-air shopping centre segment is now the lowest it's been in 15 years. And all our research on the ground indicated that the tenant demand is being tilted more towards the open-air shopping centres. It's a lower cost format than being in the malls. It is better to service buy online, pick up in store, curbside pickup, because the format is actually designed for easy entry for a customer in the car. So the format to us just had and still has better fundamentals and better way to service the customer they want to at the moment. But even the discretionary malls in the US have done extremely well. So still very strong. When we look at the leasing metrics, there's been no real change. It's been continued to be very solid demand. And bringing it back to Australia, Centre Group reported this morning, Vicinity, again, you've seen leasing spreads go from heavily negative to positive. Occupancy for Centre Groups back up to 99%. And that lease spread turning positive is on top of 6% plus rent growth, because they're CPI plus 2 leases. So you're right, the sales environment is going to moderate and is moderating because discretionary spending's under pressure. But the underlying demand from tenants has still been pretty healthy across those retail formats.
Yeah, and on that same basis, on the Australian stuff, it seems that that given the sort of a problem in terms of strip shopping, I think in terms of a lot of vacancies and things like that within that area, it seems weird that I guess the bigger guys can still get away with inflation plus sort of contracts in a high inflationary environment. At some stage, does that I guess, are we reaching a point at some point where actually, maybe I can put this another way. In a big picture sense, I sort of feel as if rents grow at inflation, plus or minus a little bit in a longer term sense. But the retailers in these shopping malls have managed to get through rent plus inflation for some time now. Does that start to tap out at some point, or do you think just the format means that they can afford to charge just a bigger and bigger premium over say the strip mall?
Yeah, if you go back to the pre-COVID period for Centre Group and the old Westfield Retail Trust, for a long point of time, their NOI growth or the net rent growth across the portfolio was in the 2s. So while they had these CPI plus 2 leases, what you found was when the lease was renewed, you were getting a step down. So the tenant wasn't paying that full CPI plus 2. That's through COVID, obviously some rents were reset given the disruption. But now coming out of it, you've got occupancy costs, which are actually lower than they were. So occupancy costs, in a raw sense, is just rent to sales for a tenant, lower than they were pre-COVID. And then they've had this very strong sales.
Well, and partly that's the high inflation, isn't it? Like you've just had whatever, over 2 years, you've had 12, 13% added to your sales just from inflation. So,
yeah, you're right. So inflation's definitely helped, but even beyond that, retail volumes have been up as well. Obviously, they're coming off now. And in the US, similarly, you've had a phenomenally strong nominal sales environment. So you're right. To what extent can this continue? Ultimately, it's driven by the profitability of the retailers in that space. And the stores are the most profitable way for retailers to fulfill a sale. No cost of delivery, no customer acquisition costs. So that's still a positive for those retail formats. But you're right, you can't compound rents at 8% without sales doing the same thing. But at the moment, healthy demand, occupancy is good. Yes, rents will normalise over time to a more moderate level. That's fair.
Yeah, but no alarm bells certainly ringing in that sector. Industrial, we saw one of the. So I guess there's 2 parts to this. I guess that I'm thinking. I guess largely the warehousing part. I suppose from this side is a number of different factors. One is we've seen the transport costs fall by which rose by 5 times and fallen back down by 80%. So we're sort of roughly back where we were with a round trip in the middle. So that's happened. we've had a big insolvency in terms of trucking in the US in yellow. And then the concept that companies have got, they want to keep more in inventories, so sort of just in case inventories rather than just in time inventories. So a number of sort of big macro factors. And I guess what I'm interested in seeing where you see the industrial, like where's the push and pull coming from in that sector? And I guess probably as the biggest picture for me is, while companies say they're going to keep more inventories, I worry that if their competitors stop keeping inventories and go back to just in time because it's more profitable, that eventually people give up and go, well, maybe another pandemic will come and we'll be short again, but maybe we'll go for another 50 years before that happens, and in which case we'll make a profit for the next 50 years. So I don't know. Over to you.
So yeah, a few things in there. I guess I'll frame the way that we've been thinking about industrial and logistics in the last few years. We're actually underweight logistics and industrial at the moment, and this is after long-term overweight positioning for us, very constructive on the space, and really it comes down to a normalisation in operations for most logistics markets, a normalisation in rents and vacancy from abnormally strong levels the last 2 years, still to a very solid environment, but just where valuations were, we've reduced exposure to the logistics market. But when we look at the fundamentals, in the US, you've still got historically low vacancy, albeit it's rising. So the tenant demand has still been healthy enough, and you've got extraordinary mark-to-markets, like 70, 80, 90%. And that is simply that when a tenant leaves, the new tenant will pay the market rent, which is 70 to 80% higher in areas like Southern California, New Jersey, New York. So those coastal markets, you've got extraordinary mark-to-markets because market rents increased so materially, because vacancy in Southern California was 1.5%. Vacancy in Australia is 50, 60 basis points. So that dynamic has led to very strong rental growth, but cap rates compressed to a point to reflect that, which is why we took some money off the table. But the demand is still very strong, albeit moderating from exceptional levels. And as economies slow, we expect that demand to continue to moderate.
Yeah, and do you think? I think of industrial, and particularly the warehouse part, as being the simplest part. I just need to stick a shed up on a cement, on a bit of cement, rather than sort of having to build lots of facilities like you might need in commercial and those types of things. So the expandability would seem to be faster, but I'm guessing that people weren't expanding as rapidly because we don't know how much of this is temporary and how much of it's going to last forever. Is that? Yeah,
you hit on one of the big issues in parts of the logistic market, because you're right, when there's land available, there's demand and capital, developers are there, and you're seeing that. So when you look at a supply chart in the US, for example, a lot of the ramp in supply has been in industrial and logistics markets away from the coasts where you've got land availability. The markets where you're seeing the strongest fundamentals and where you want to invest has been in Southern California, because there's just no land available, which is why vacancy was so low and rents spiked. Parts of Sydney, southwestern Sydney, similarly, because you've got alternate use like residential and other things taking out land. Parts around central London, around Heathrow Airport, again, the land availability is actually coming down, and that, given the need for logistics to be closer and closer to the population centres, has been a big driver of what's happened to market rents. But you're right, there's been a massive supply response in places in the middle of the US, Inland Empire East, in California, where you've got land availability, Texas, these sort of markets. So that's where the risk is greater. Melbourne, for example.
Yeah, I hadn't thought about the whole alternative use part, because it's a bit like all the building companies for a while. They made bucket loads of money from selling their old quarries.
That's Brickworks is still doing it with Goodman.
Yeah, so just for listeners, you build a quarry on the edge of the city, and then the city expanded past you, and then you sold off your quarry for ridiculous amounts to build houses.
All the market gardeners in Western Sydney selling off, to land developers.
Yeah. So is that And so is that similar then in the logistics market, or at least it's being affected, I guess, is what you're saying? Is that,
It is, yeah. So one of the positions we've got in the portfolio, Torino, I think it's 50 or 60% of their markets either had flat or declining land supply. So that's a big driver, the availability in these close population centres.
Yeah. And then I guess, depending upon, if you are going through population growth, I'm just thinking of stuff around Melbourne where there's lots of places where, the inner city stuff is all turning into high-rise apartments and stuff. So you can see where that's, even if you have a weak industrial market, a strong residential will help bail it out.
Well, even now, the alternative to that, evident in Goodman's results, is data centres. So they're looking at, and this is not just Goodman, but Seagrow and some of the others, these large pieces of land that have power, they're actually finding that the demand for data centres is driving pricing at 3 times what they can generate out of logistics. So that's another example of, alternate use for well-located large plots of land with power in the right locations.
Yeah. Excellent. Okay. That's sort of reaching towards the end of my questions. Do you have anything big, I guess, in the sector you think I've missed? That's in terms of.
Yeah, I think the big, some of the big themes that have been driving returns, we touched on a lot of them. So industrial logistics, e-commerce. I think one that is maybe slightly different for your viewers is rental seniors housing. So it's not something which is common in Australia, but in the US, rather than your DMF type model for your retirement.
You might have to get some acronyms there, DMF.
Yeah, sorry. So deferred management fee. If anyone who's had to put a parent or a grandparent into care, you'll know there's a deferred management fee and often a bond. Whereas in other markets, it can be a true rental model. So you just pay rent for your care and for your apartment or your home. So in the US, it's a rental model. It's private pay. And when you look in the US, you're just hitting that point where the over 80s baby boom population hits into this need of care. In the US, that population is going to grow at 4.5 times compound out to 2030. So very strong demand profile, which is baked in because it's demographic. And at the same time, you've had supply collapse because of construction costs, finance availability. So just as you got this demand ramping up, the supply of new seniors homes is really declining. So one of the largest positions we've got in the portfolio, Welltower, is exposed to this seniors housing dynamic because we think it's a multi-year trend providing needs-based space and accommodation and care to a demographic which is growing, and it looks like it's got a pretty healthy multi-year path ahead of it. So that's another segment, healthcare real estate, which you can't really get access to in Australia, which you can in other markets.
Yes. So when you say healthcare real estate, does that also have some sort of hospital type factor in it, or is that, I guess when I hear the name healthcare real estate, that's what first comes to mind? Is that?
Yeah. So seniors housing is in the US. It's put in the healthcare sector, and it's lumped with medical office buildings, for example, where you might have outpatient care, clinics, etc. So that's also in there. Then you've also got some post-acute care and SNFs, those senior nursing facilities. But the majority of Welltower is seniors housing. But there's a broader healthcare real estate bucket. There are hospitals there as well, but there's only, within our healthcare exposure, I think there's a very small percentage of hospitals. But yes, it is in that bucket.
Yeah, and my guess would be, just spitballing here, is that the healthcare, the outpatient stuff and the that it's not that dissimilar to office. You don't really need much extra. Am I right in terms of, a hospital is a purpose-built facility. I guess what I'm wondering is your average doctor's offices doesn't seem to be a purpose-built facility for me. That's, so you're effectively trading on not CBD commercial office space.
Yeah, there's a few different dynamics there because they typically they want to be on campus, so either on campus, on the hospital campus, or closely adjacent. So there is some supply constraints there. The fit outs are more intensive, and typically the doctors don't want to move a lot, so you'll find there's a stickier tenant. And the other big trend is trying to shift more procedures out of hospitals into these sort of facilities because of the cost. So there's a trend to try and get more procedures into these outpatient and other medical facilities. So it does operate with different dynamics to the office market. The cap rates are 6.5% to 7% in the US versus 8 to 12 for traditional office. So the medical office type tends to be a more stable profile, less economically sensitive, and again, it's needs-based with some decent underlying trends to the demand.
Yeah, right. Yeah. It's an interesting one. Excellent. Look, thanks a lot. Really appreciate your time. Sam, have you got anything?
I'm just going to jump to the sales message, and then we'll come back and give Julian an opportunity just to talk about Resolution Capital. And so I'll just cut that bit out, but I'm just going to sales message now. We'll be back again shortly. If you like what you're hearing but want a low-cost passive option, Nucleus Wealth is the first to offer passive direct indexing in Australia. The first generation of passive investing was index funds. The next gen was ETFs. Now direct indexing is here with significantly more customization and control. The benefit of direct indexing is you can add or subtract investment themes, and we have almost 100 different options to choose from. For example, you could buy an international share direct index portfolio that excludes fossil fuels and arms manufacturers and has a tilt towards cybersecurity and cloud computing. Alternatively, you could buy a portfolio with no screens and an extra exposure to nuclear power and defense contractors. You can find out more at nucleuswealth.com. Now back to the show. So Julian, thanks for coming on the show. We'd like to give you just an opportunity just to talk a little bit more about Resolution Capital and let the viewers know where you can find you guys.
Yeah, thanks, Sam. So appreciate the opportunity today to discuss with your clients a few of the major trends we're seeing. If you've got more interest in what ResCap's doing, rescap.com. And in terms of the way that clients can invest in the strategies, we've got the active ETF, RCAP, so easily accessible by your ordinary broker, or we still have the traditional unlisted funds, both in hedged and unhedged. And across the broader platform, we've also got domestic REITs and real assets. So more information, please reach out.
Fantastic. Thank you so much for coming on the show. It's been a really interesting discussion about the many different sectors in the commercial property world. Thanks again, and we look forward to seeing you next time.
Thanks very much.
Now we have our question of the week. So this is for viewers to have some discussion in the comment section over the coming days. And the question for this week is, how concerned should we be about commercial property in the US? So feel free to post your thoughts and engage with us and some of our other viewers over the coming days. And now, Damo, over to you for investment implications.
Thanks, Sam. Yeah, so look, interesting conversation. I think just in a big picture macro sense, in terms of when you're seeing rising interest rates, tends not to be the time for property sectors to perform well. And the other factor and part of the reason for getting on, we're obviously talking a lot about the debt, is that you can get caught in this part where you're seeing values fall because they've priced very similar or they're priced a lot off interest rates. So you're seeing values fall at the same time. If you run into this with too much debt and suddenly the interest rates jump, that you can start running into some real problems that we've seen during the financial crisis and back in 91 there was sort of commercial property, particularly in Australia. And so keeping an eye on where the leverage is very important. As he spoke about, there's a few areas you've got to be careful about, particularly that commercial property in the US. But beyond that, there are some interesting sort of parts where you can sort of see some fundamentals and with a view that interest rates are close to peaking. There's potentially some place you can start looking for some safety. But the big thing, I just want to keep coming back to on all these property ones is making sure those fundamentals stack up, because you can get into the phases where, and we saw it, during the financial crisis, where what were looked upon as very safe and very steady businesses, if you see some rapid turns, say in the retail sector and what people are willing to spend, or in the industrial sector, then you can, and you're getting with a lot of leverage, those can come unstuck quite quickly. On the flip side is if property sector will be less volatile than other sectors, and if you don't have that leverage problem that you've got too much debt, then you can find some safety if you're looking for downturns within this. So certainly one of the areas we're looking at, and which are the parts of that that have those underlying fundamentals within that. And so that within our portfolio, there's a number of these more the esoteric subsectors like the self-storage or the or some of the telephone towers that we've sort of been more heavily into. And I think we probably will have a bit, as his discussion, we will have a bit more of a look at some of these healthcare and see whether we like the fundamentals versus the pricing we can get within those as well.
Nice one, Damo. And I just want to add that, as the viewers likely heard, we have around 100 different screens and tilts. And I just want to throw out a couple of ideas of how viewers or clients can play these within the Nucleus Wealth portfolios. On the screens side, so you can exclude, we have a sector no GICS sector real estate. So you can exclude all the real estate there. And then with the tilts, you can add in extra exposure to global real estate, depending on if you're bullish or bearish on the sector. So that pretty much wraps us up for today. So Damo, again, thanks for everything. Thanks for putting the show on, and we look forward to the next discussion next week.
Thanks, Sam.
We really hope you enjoyed and got value out of today's podcast. At Nucleus Wealth, we thrive on putting out low-cost, innovative products, and we want to continue to do this and create great content for our listeners and clients. Subscribing to our channel will help us do that, so we'd love it if you hit the subscribe button now. Also, if you know of anyone that might get some value out of today's episode, we'd really appreciate it if you do share it with them. We also put out a lot of other content in addition to this podcast. We have regular articles that are featured in all major Australian publications, and we also have the Nucleus Wealth Empower podcast. We just put out an episode on Nucleus Wealth Empower recently about the changes to super and also how to take advantage of super splitting opportunities. To get all this in your inbox, you can subscribe to our weekly Nucleus news at nucleuswealth.com. We do welcome your feedback on this podcast, especially in regards to suggestions for future topics. If you do have any ideas, drop it in the comments section below or send us an email at contact@nucleuswealth.com. So from myself, Damien, Julian, and the rest of the team at Nucleus Wealth, thanks for watching, and we look forward to seeing you next time. Bye for now.